Good afternoon, everyone. I'm so glad to see you joining me here today for our Selecting an Options Strategy webcast. I'm Connie Hill. We do this each and every Wednesday afternoon where we'll kind of look at what's going on in the markets and what types of strategies might be most appealing in that kind of a market. So I'm glad you've joined me here today. I have in the chat Brett Crowther. He's one of our coaching managers. So I got to tell you, be on your best behavior. All right, because Brett will be looking out, making sure my back's covered. He will also be here to help answer any questions that you might have, all right, that maybe are pertinent to our discussion or maybe a little bit off. He'll be able to help out with those, and I'm going to keep my eye on the chat here as well so you can get your questions answered. If you're listening to this on the recording, and I know lots of you do, when you have questions, go ahead and put your questions in the comment section. I'll go back and review those throughout the week so you get your questions answered quickly here as well. Let's go through our disclosures and lay out our agenda for the day. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for information and education purposes. Do not consider it a recommendation. We will be using the Paper Money software application. This is what you download to your computer. It's the most robust version of Thinkorswim. Spread trading must be done in a margin account. Past performance of any security or strategy does not guarantee future results or success. When we talk about stop losses, keep in mind there is no guarantee of an execution of a stop order at a particular price when we're using stop market orders. All right, our agenda, as I said, we're going to review current market conditions. I want to talk a little bit more specifically about what maybe should you do when we see some bad news. Okay, it's kind of been a bad news morning here for many stocks. We're going to take a look at some of them and maybe take advantage of that and see what might be appropriate. And of course, we're going to be looking at a lot of different types of examples here today. So let's jump over. Let's start out on our SPX chart. All right, here's our SPX chart. You guys know, you've probably been following week after week. Seems like we're hitting a new high, right? So we've got quite a bullish marketplace going on. Today, yeah, we're seeing a little bit of a pullback. Is it anything to be overly concerned about? Probably not. I mean, it just barely closed today below the 10-period moving average, and it hadn't done that for several days. It's not even to our 30-period moving average. So really, the trend is still intact. In fact, some people would say, maybe kind of looking where were the previous major lows, might be down here in this area. And so really, we wouldn't have a lower low unless the SPX really came and went lower than this area. It's about 56.80 or so. And so people will be keeping an eye on that. Yeah, we're having a little pullback, whatever, right? Let's look at the Russell 2000. It's probably, interestingly enough, it was getting close to its peak earlier at the end of last week and this week, but definitely it has pulled off as well. It would not be really going past a previous low unless it got back here around 2170. Okay, let's look at the volatility index here. Volatility index, you know, it's kind of sticking around 20. 20 is not incredibly bearish, right? If we were to just zoom in, we're going to not zoom in on this very high volatility day here. We're going to go in a little bit after that so we see a little bit of movement in the VIX instead of seeing it all squashed together. But here we can see, yeah, the lows have kind of been around 14, 15 recently. The highs on the VIX, which really are not super high, but kind of the range the VIX has been going up to is about 23 or so. Now, if it were to jet past that, then there might be a little bit more concern in the marketplace. But right now, it's just kind of, the VIX is in a little bit of a narrow range. It's not as low as it has been, but it's not incredibly bearish yet either. Okay, so we think about these things all together. The last one I do want us to look at is DAX, the NDX here, NASDAQ 100. It and the S&P 500 have kind of been trading together fairly similarly. The NASDAQ isn't making the higher highs, or all-time highs, I should say, every week, although it's still trending strongly and of course a little bit down here today. Its previous low might be down here maybe around, say, 19,690-ish. All right, but so far still kind of sticking with the uptrend. Now, some people might look at this and wonder if we've got a price pattern going on here, which we might. So let's just kind of be aware of it, okay? We've got a peak right here. We've got a very slightly higher peak here. It's not tremendously higher. Then we have the little pullback, and we have maybe a little bit here. Now, this is a little bit what might be looked at as a head and shoulders pattern. Usually a head and shoulders pattern is spread out over a little bit more period of time. But if we just kind of take the idea, well, is the NASDAQ maybe topping out? Then we might consider looking at it from that angle as well, that maybe it's having a hard time getting higher. And so maybe it's going to be in a little bit of a sideways pattern for a little bit of time. All right. So we all know there's going to be volatility in the next couple of weeks as we're approaching an election cycle, right? And who knows what the markets will do based on that. And now Kevin's saying, hey, there's a bearish divergence between the VIX and the SPX. Let's go back here to the SPX and see what Kevin's saying here. I think what you're seeing, Kevin, is we're seeing maybe some higher highs on the SPX and would be expecting to see maybe in that case lower lows on the VIX, and we're not. That might be what you're trying to say, Kevin. If I'm not reading you right, let me know. Okay. But yeah, SPX certainly making those higher highs. And again, I'll zoom in on the VIX here where it's a little bit more compressed. And so if the market's making higher highs, why maybe are these lows not getting a little bit lower? Okay. Something to notice. Sometimes we have a divergence and it's just kind of a yellow flag saying, hey, pay attention, something might be changing. It's an inconsistency. Sometimes these inconsistencies and divergences may go on for a long period of time and the market doesn't really change. And so people might take note of it, like the yellow flag, but they may wait for price confirmation that something is happening because of that divergence. Appreciate you pointing that out. BJ says, you know, the NDX is forming an ascending triangle. We can look at that, because it's really interesting. Sometimes in markets, you're going to see multiple types of patterns. And so what you might be noticing here, BJ, is you might be looking at this kind of what I was saying, like a topping pattern. And maybe that's like the flat part of the triangle. And then you might be looking at a pretty long triangle here. We'll just start it maybe with this area here. would have to pull it back here to the low today. This would have been a pretty steep triangle. And so, yeah, we could have an ascending triangle here that's a bullish continuation pattern, while at the same time seeing a little bit of resistance. And to have both those patterns in there is actually what's normal, right? It's normal to have a flat top when we're looking at an ascending triangle. All right. Well, who's had some bad news today? Does any stocks have some bad news? We've got a couple of them that have. And we're going to look at maybe some setups to see what the market's like. The fairly in a fairly strong position. But there may be times when stocks have some bad news and we might want to possibly take advantage of that. Now, here's ARM Holdings. They and Qualcomm had a situation going on, and both of them are reacting negatively to that news today. I think there was going to be a partnership of some sort that is getting foiled a little bit. You know, so here we're seeing that really ARM Holdings has been in an uptrend. Let's zoom in here a little bit tighter, but maybe looking at, say, a recent low might have been right here around 147. Some people, if you're micromanaging the candles, might look at it that way. There could be others that say, no, you got to go clear back to here. I'm looking at it that way, that really is it starting to form maybe a little bit of weakness that we could take advantage of. Now, when weakness creeps into a stock or the market, what happens with implied volatility? Well, it tends to go up a little bit, doesn't it? Let's throw on our implied volatility. This one doesn't have earnings coming up super soon. All right, so let's put that there. Drop our volume down there. And so we can see, you know, kind of a hint of increased volatility, implied volatility here today. But this one has, by and large, has decent implied volatility priced into the options. As we come over here to the trade tab and start here, probably going to use these November options, but I want you to see implied volatility for all of the options that are coming up. They're in pretty high ranges, right? 63, 60, 93, 89 in the November 15s that we're probably going to use because of open interest and having some good open interest there. But it's still in a fairly high range. Now, earnings are probably going to take the place the week of the options that expire on the 8th. Okay, I think it's the 5th. We'll go look at that date exactly. So it's going to have the highest implied volatility typically for when we're looking at the different expiration dates. Yeah, those that are coming up soon with earnings typically is a little bit higher. Now, it's not, I'm going to say, incredibly off the charts higher, but, you know, it is significant, you know, 27 percentage points, you know, from the 60 and 64 here. We go back to the chart. The earnings are on November 6th. I thought maybe the 5th, but it's really the 6th. But that falls before that options expiration. Now, let's maybe see if we could put together a trade and take advantage of maybe this short-term bad news, okay? Sometimes bad news doesn't last very long. It's interesting that I don't know what the implied volatility was previous to this bad news coming out. We could go to think back and maybe look at that. But what I'm looking at here is if implied volatility is a little bit higher, maybe we can get some juicy premiums by selling some bearish call spreads. Okay, so that's kind of what we're looking at here. So lots of open interest here. You guys know I'm a real stickler for open interest. I really like to see lots of contracts being traded and selecting to use the contracts that are being most widely traded as opposed to maybe something like, you know, here's some that have 31, and 31 is not horrible. The spread on it is fairly tight, but if this number doesn't increase, that makes it really hard to exchange contracts with, right? Now, introduction of $2.50 spreads was introduced recently to this series. And so they're the ones typically, the ones at the 250 increment that don't have as much open interest. So as we come down here, we may be looking here, see if it still looks good what I was looking for here earlier. I was looking to go 160 and 165. Skipping by the 162.50 because of that lower interest, open interest. Okay, let's see what kind of a credit we could get here. Knowing there's only 23 days before that option expired, many times traders like to sell between 20 to 50 days worth of time. And so there's a few options in there that we could choose. So we're going to go on the small range of that and intend to see what we have here. So we're going to go ahead. We're going to sell a vertical. I'm going to lock this in because that number is going to float around a little bit. 55-cent credit on a $2.50 wide spread. So we want to see, does that give us a good enough return to be interested in? Okay. Probability on this one. Let's add that column back here. Let's look at our probability out of the money. Okay, probability of our 160 strike price expiring out of the money is about 75%. So typically anything above 60 is what we'd consider higher probability. So it's starting out there at about 75%. Okay, so that looks nice to us, right, as a trader. Let's go calculate a number here. Let's go our 55 divided by, that's going to be what, 135? 55 cents to gain for every 135 that we're going to risk. Those two add up to that 250 spread. Well, that's about a 40% return. Now, it's actually a little bit nicer than what I was looking at earlier, which is fine. I was looking at something in the high 30s, so looks like it's bumped up just a little bit there. Okay. So some people might say, okay, maybe it's worth the reward for a period of time. Now, what if we just wanted to take advantage of it for maybe a short period of time and try to get out before they announce earnings? Okay. You guys know I like to put in some orders to exit when we put in an order to sell a spread. Now, risk-wise here, if our risk is 135, we don't want to risk more than 750, so we'll divide that by 135. We can do 5 contracts here. So let's do it. Oops, wrong one. Let's get our 5 contracts here. We'll do a first triggers a sequential and now create an opposite order that we're going to put in to buy back here. Let's see here. The 55,195 says Frankie. And so I'm wondering if you're saying here, looking at maybe the 155 strike price, maybe 155 and 195, that would be a huge spread, 155 by 195, but you could do that. You're saying 28% maybe for that spread? Very well could be, okay? Unless you're referring to my math. I'll double check my math just in case, all right? 2.5 minus 55. Oh, it's $1.95. That's what you're cueing me into. I did my math wrong. Okay, let's figure this the right way then. All right. I said 135. 195 is going to be the max potential loss. And then 55 our max potential gain. All right. Thank you, Frankie, for saving me there. 55 divided by 195. 28%. Okay, this is 28%. It's actually a little bit lower than what I was looking at earlier here. So some people might say, that's too low. Some people might say, well, they might say it's too low if they have a threshold they want to meet, like say 30%, 35%, 40, something in that range. Some people might say, you know, as long as I can get a percent for remaining day till they expire, they might be satisfied with that, right? A percent per day. So in that case, it would pass the mustard for that. So we're going to go ahead. We're going to go ahead with this trade. And we've got to redo our contracts here. This is probably going to take us down to 3. Let's go the right way on this. All right, let's do 3 contracts. We'll still stay below our 750 max theoretical or max loss that we want to risk in any trade in our account, our example account here. All right. Now, what if we could get a chunk of this? What if we could get like 50% or 60% of this in a fairly short period of time? Would that be worthwhile rather than waiting for the whole time, right, to getting closer to options expiration date on November 15th? Sometimes we'll put something in there that's maybe a 75, 80, 85% max gain. In this case, what if we were to say we're willing to take a little bit less credit there in order to maybe have a quicker trade, hopefully getting out before they announce earnings, okay? Let's take that approach. If that's the case here, if we were to take our 55 cents and say, what if we could get half of it, okay? 0.5, if we could get 27.50, 28 cents and get out early, let's try it, okay? So we're going to put it in here to buy it back when it gets, make sure I did my math the right way. If we get 50, well, it's half, okay? It's 27.50 is 50% there. Let's put it at, let's round it to 28 cents, okay? Make this a GTC. With the idea that we want to be out earlier if we can just kind of capture some of that implied volatility, some of that premium, okay? Let's go ahead. And yeah, here our max loss is 585, so we're staying below our 750 there. And we're going to put this in our option strategies bucket and send that on. All right. Who else has had some bad news today? Well, Qualcomm had a little bit of bad news. I want to take a look here. Starbucks had some bad news. They announced early, a little bit early, on their earnings, right? They're having a new CEO come in, and they announced their earnings a little bit earlier. Could they be kind of hitting a little bit of a top here? They could be. We don't know for sure if that's the case, but theoretically here, possibly so. And, this kind of looks like maybe some support here about 90, 94. And actually, I'm going to pass on this. This has changed significantly enough since I looked at it earlier today. What I don't like about it is the rebound off that support level. We're going to pass on Starbucks. They did have bad news. New CEO's coming in. He's trying to paint a bright picture for him, which is fine. All right. Let's take a look at somebody that's going through earnings today. Okay. It may be good news. It might not be good news, right? Tesla. Talking heads are maybe a little bit pessimistic about it. They had that event earlier that caused this gap here. I think it was about their Cybertruck, and it didn't turn out to be so good. Okay. The market maker move I've got showing up here with that script is showing us the expectation of what's being priced into the market for this. Okay. So it's a fairly decent move. When we go to the trade tab, we're going to see it's about $15 priced into that move. And Tesla typically does move pretty decent. Now, the options here, let's kind of look at this. Look how much implied volatility is priced into these options that are going to expire Friday. Okay. That's because of that earnings announcement coming out. And sometimes traders might want to take advantage of maybe seeing if they can capture some of that implied volatility that has been priced into those options. Okay. So we see our market maker move on the chart. And sometimes when people put together trades, they might try to use that area and try to maybe set it up to go beyond that area. Now, what we're looking at here is maybe to see if we can get enough of a spread here, a wide enough, I'm going to say a wide enough area that we could maybe do an iron condor, that we could do a short vertical spread and a short call spread, with the idea that, hopefully it will continue to stay in this area. And so we're going to sell some legs just a little bit beyond this market maker move. Now, I do hope you do have this script. If you don't have it, I'll share it with you in my notes. When I go back and do my post-production work, I'll put the script there for those of you that are interested in it. And we can see implied volatility is kind of ramping up like it typically does, although it's in a higher range already. But as it goes into earnings, looking like it's moving up there. So let's go construct this trade here. We are going to play it for earnings. Some of you like to trade earnings, some of you don't. Since we're in earnings season, I like to include at least one earnings trade if it looks like we could do something with it. Okay, so we're going to put on an iron condor, which is the credit spread for both the put side and the call side. And this is interesting because we can go out pretty far out of the money on these strike prices. Let's see if this still looks good. I was looking at doing 232.50. Love the open interest there, 39,000 contracts. And what's the probability of expiring out of the money? Well, right now, about 83%. Okay, so that is higher odds, although nothing is ever certain, is it? It's just a probability that's theoretical in nature. We're going to do 232.50, 235 here. And so I'm going to do this, and we're going to set it up this way. I'm going to sell it as a vertical first versus an iron condor, because I kind of want to see how the premiums are faring for both sides of the trade. Okay, so about 42 cents. No, that went by. Let's try that again. Actually, we'll just switch it there. Okay, there we go. Selling our 235 there, or 232.50. Buying the 235. Now that's about a 19 delta. So we're quite a bit ways out of the money. Let's see if we can get something similar to that on the put side. when I was looking near a 20 delta earlier, the premiums were, I'm going to say a little juicier than I expected, but right now it's actually looking pretty good. Okay, so we're going to change our single order to a blast all so that we can have these together, although we're considering one trade. So we're going to go with our 197.50 and 195. Sell that vertical. And it is higher. I told you earlier when I was running some numbers, looking at similar deltas, we're getting a little bit more premium in. And that can happen sometimes. The premiums are not actually identical, even though you're starting out with similar deltas. The question that somebody could say is, well, would I prefer a little bit more premium, or would I prefer a higher probability trade? Because notice here, this is 77%. Do you remember what it was on our call side? It was about 83%. Okay, so somebody, and there's plenty of open interest regardless of any of the contracts that we might select here. We might decide to go out a little further. What if we sell 195? Let's maybe get rid of this. And let's sell the 195 and buy the 95. Okay, if we sell that vertical. Oh, dang it. I needed to move it up. All right, here we go. Sell that one. And then it's coming in a little bit more comparable. A little bit higher probability. Now we're up there about 81%. So about 4 percentage points, a little bit better probability. We're still getting a pretty decent credit here, right? I'm going to lock these in. And the expectation here is implied volatility is going to collapse. Our market maker move here was about $15, $30. And the strike we're going to be short here is 195 and 232.50. So I'm going to go to our chart and let's plug in our 195 down here. Put that again. Come on. Price level 195. Okay, so it's just a nose below the market maker move, and then 132 or 232.50 is going to be just a little bit above this move here, or this market maker move line here. All right, I'm just going to do it pretty close. I'll go back and fix it right smack to the exact number. And so we're looking to say, okay, let's see if it trades in that range. If it's possible, we could collect 2 credits. It could be, though, that we only really take in a significant part of the gain on only one side of the spread, right? If this drops down here, well, our call spreads are going to be looking pretty nice, right? And if it goes the opposite way, Tesla has good news, pops up this way, then our put spread is going to be looking really good. And so we're going to manage them a spread at a time, as opposed, but recognizing we're putting together an iron condor. Okay, let me see if we have, let's see a couple of questions here when we're talking about that. Isaiah says, you know, why a 19 delta, not a 31 delta? Yeah, the reason is I'm going further out of the money on that is because I wanted to be outside of this market maker move. And if I chose something with a 30 delta, it was going to be inside the move. Although many times people will target a 30-ish delta on a credit spread, right? But because it's earnings and because we're expecting a decent move, it would be nice to sell that implied volatility and have a little bit more wiggle room. Now, it's not guaranteed that we would make money on both sides. We're going to bring in this credit here initially, right? Which is going to be 79 cents. If we have a 79 cents divided by the max theoretical loss there, let me figure that out real quick. Theoretically, we could lose on both ends. Probability-wise, not necessarily so, okay? So if we were saying, okay, our risk is 250 because maybe we might lose on a side, 250, and let's go say 38. So let's go 212 in risk. About similar for both of those, okay? So we're going to take our 89 cents, no, our 79 cents, divide that by about 120. I did that wrong. Flip that, okay? That should be times 20% that might be left. Let me redo that, okay? We're going to go 2.5 minus, let's go 40 cents, okay? Kind of in between here. So we'll have 210 as, I think I did a typo there. I had put in 120 instead of 210. I think that's why my math went screwy there. So we're going to say 210 is our theoretical risk on one side, hopefully not losing on both sides, although we could, right? If we had the worst luck in the world and it ran up and we got out and it ran down and we got out of the wrong spread, that could happen. All right. So we're going to say here in the neighborhood of about 89 or 79 rather. Divide that by the 210, we're getting in the neighborhood, if we were able to collect that, maybe about 37% return. So some traders would say, gee, for a 2-day trade, that might sound very healthy. Because it is more speculative, we're not going to do a ton of contracts here. We're just going to do a couple on that, and we're going to put them in our bucket. And the expectation is that when we talk next week, I'm going to show you what happened to them, right? Because they will have expired by Friday. Again, not everybody likes to trade earnings trades. Here's something that you could look at if you're trying to say, let's try to see if it'll stay in that market maker move and capture that implied volatility. Now, I did notice it looked like we had a survey out in the chat. I'm going to go back here and take a quick peek, and Brett will probably post that here again. I'm not seeing it at the moment, but I think there was a little survey there. And those of you that come to our classes know we'll do a survey from time to time, right? We want to check your pulse about what you're liking, things that you'd still like to see. So there's 2 radio buttons for 2 questions. Just pop on a scale of 1 to 10. Just pop your answer in there. And then if you want, there's some questions you can respond to. And it's really helpful information for all of us to be able to see that. It's helpful for me. It's helpful for our managers. And I like to incorporate your questions and things you're interested in into our sessions here, right? Because they're for you. We want them to always get better. Okay. So if you'll maybe click on that link right now, wait till we have to leave or the session's over before you actually fill it out. We always appreciate it when you take the time to do that. And yes, it's posted there again. Now, Isaiah says, well, how could we possibly lose on both sides? If we had extreme movement and you closed out the wrong spread, okay? So if we had extreme movement on Tesla and it popped up here and went really high on our call spread and we tried to close it out rather than like say, kind of taking our gains on this one, right? The put spread, if it popped way up there, our put spread would look good and we might manage that winner. And then say we might have a loss on the call side. But the way that it would work out that we could lose on both is if we closed out both of those spreads unnecessarily. Meaning if it's sitting in the middle, we're just going to let it erode. We're going to let time decay work and do its thing. We are going to pay attention if it goes beyond our boundaries because we may need to close that spread out early. Okay, but we should be taking a winner on the other end. It's just if you kind of get too excited and you close out the wrong spread, okay, then theoretically, if you're taking a max loss on both of them. Okay, so it would be kind of like trader error, not necessarily, but it could happen. Okay, if you got really nervous, hit the wrong thing, it could happen. All right, let's see here real quickly. Yeah, so for checkout, yes, this one that we're going to do in our example trade is set to expire this week. And again, they're going to announce their earnings after the market closes today. Now, looking through, seeing if there's any questions that I need to capture here. I think Brett is helping me out with those. think we are in good shape. Yeah, for checkout saying, yeah, there's quite a few different ticker symbols that are dragging the market down right now. That is true. All right. Let's do this. I need to follow up on a couple of trades, and I think that's an important part of what we do in our class, is following up on some of those previous trades. So we put in the iron condor on Tesla as a new trade, and then we did that arm holding that we're doing a short call vertical on it as well. But from previous trades, let's take a look here. We did 2 trades. We're gonna look at the charts on these. Last week we did 2 trades that were very bullish because we did a long synthetic. So we bought a call, we sold a put, both very bullish trades, right? Both legs were bullish. So if the stock didn't go our direction, we would really possibly take a loss there. Okay. The first one here was RKLB. All right. I want to show you what happened here with this one. This was the day we got in, and it really did not move a whole lot. Okay. And it wasn't. So what is happening to us? Well, the put is helping us because time is decaying there, but our long call, it's hurting us. It was really hurting us. It turned out we made like $5 on this trade. I went ahead and closed it out earlier today when it just was not moving, okay? Because that's what can kill us. If it doesn't make a big move, that's what happens, okay? Also had to get out of today, out of VST. And VST had actually moved quite a bit more. We got in, our class was on the 16th, so we got in on this day. And what happened? Went down initially. We were going to give it some time to recover. Looked like maybe it was going to recover then. Today again, it was on its way down. I was like, we're just going to have to take a small loss on it, close out the trade. We were expecting big moves. We were looking at big deltas, big betas on those 2 trades, looking for kind of an explosive move. Here, we were seeing that it broke out of the flag, and so we were hoping for another flagpole type move. All right. I did a roll. Okay, I had to do a roll without you guys. That's all right. On Gilead. Let me kind of close that one up. On Gilead, we had an option that was going to be expiring in 2 days last week. So it was going to expire on the 18th. Well, we had gained a little bit on it, but not maybe as much as we would have liked to. Okay, so I rolled it to now what would be an 85 call. We're short that one. We brought in 283. Earlier today, it was down. We were actually making money on that leg that we sold. Right now, it's pretty close to even here, so it's down a little bit. However, our long option, and that's the one we were having for a longer duration, the one that we're planning to hopefully make most of the money and just sell calls against it to bring the cost basis down, it's moving really nicely for us, as we would want it to have happen. I'm going to see if this can just erode a little bit more. All right. See if we can't close it out, meaning buy it back at maybe a little bit of a gain. All right. We see today kind of, our long legs moving along there, but pulling back here a little bit today. Maybe it'll pull back a little bit more, We're in that window, right? 5 to 10 days out is when a lot of people like to buy back those short legs. And so, man, we are smack in that window. So we're going to have to be watching it close tomorrow and Friday. Okay, the rest of the week. See if we can't get it in a more favorable position where we can capture a little bit more of that profit to help go against our entire net debit for that diagonal. Okay, let me see if you have any questions on those 3 trades real quick. Just looking here. A trader says, what's the meaning of live news that says maintains a $10 price target? Will be going up. Is this true? That must be of a different stock, not one stock that we're looking at here, trader. I think it's of Target. I don't know if it's of Target stock or, no, it's not Target stock. It's not $10. When agencies release ratings, Okay, and when they are maybe changing their price targets on stocks, if they said, like you just said, they are maintaining, it means they're not changing their position. Okay, so they might say, we're maintaining a hold, we're maintaining a sell, we're maintaining a buy. Usually we see things on the more positive side than versus a lot of sell type, right? So if they're maintaining, they might just be changing the target only, but not necessarily what they think you should do as far as holding on to it, selling it, or buying it. Okay, that is the meaning of that. Now, Isaiah says, so to be profitable in an iron condor trade, the best thing is to close both sides. So back here on Tesla, because that's our iron condor trade, right? The best thing that could happen to us is that it stays within the bounds of the market maker move. Okay, that's where we'd ideally like it to stay. We have a little cushion on either side of those. Okay, we have a little bit of cushion, not a ton. But that's ideally what we'd like it to do. And if it does that, then it could be that we don't have to buy either of them back and we just keep the premium we collected. But it's something you have to stay on top of. You have to watch it more than once a day. Okay, you've got to see what the reaction, you don't have to see what the reaction of the news is because it could change in the morning, right? Pre-market could change things, but we want to stay absolutely on top of it, probably, multiple times a day. All right. Well, you guys, we are out of time. We've covered quite a bit of ground as far as our management of trades, the ones that are still working, and of course, these new ones that we're going to follow up on next week. I'll remind you that I hope you are a subscriber to our Trader Talks channel. Okay, if you're not, I don't know what you're waiting for. Okay, it'll allow you to get to our content more easily when you become a subscriber. Okay, you can go to the playlist of maybe some classes you're listening to if you want to go back and listen to some of our previous classes here on different strategies we've explored. We have some new playlists for you that include this one here, the most popular. Okay, so when you become a subscriber, it just helps you find that information. I subscribe to a lot of different YouTube channels, and it makes it a lot easier for me to go find what I'm looking for and see when the most recent series is out on something like Trader Talks. Okay, it allows you to do that so much more easily. All right, as we finish up here, these are all the strategies we can pick and choose from. Today, we're focusing on maybe a little bit of short-term bearishness because of bad news. All right, and technicals that also support that, as well as kind of a speculation on that Tesla trade. All right, so we saw what was going on with our news, looked at some different examples, existing trades, as well as a couple new trades that we want to be able to follow up on. Thank you, Brett, for posting again that survey in the chat. And we appreciate it when you take the time to do it. It doesn't take a lot of time. I like short surveys, and it's a short survey, so it's one that even I could deal with. All right, but we do appreciate your input. We like to use it in our future sessions. All right, now coming up next is going to be Mike Fairborn with Market. Oh, actually, it won't be Mark. It won't be Mike, but it is his class, Market and Sector Analysis. I think Mike is out today. But that's the class that's going to be coming up next. All right, we'll see you in about 15 minutes at the top of the hour. We'll be back. We'll see you then. Bye-bye.